Hello, everyone. We are back. It is March, so it is a new roundtable. Yes, it is a roundtable because there are three of us. There are some questions. I would like to address some of the viewer comments right away. It's great to be back here with John in Toronto and Steve in Vancouver. How are you guys doing?
Always a pleasure.
Good to be back.
It's been a while. There's been a lot of things happening in the market. So yeah, excited to sort of dive into it this week.
Yeah, I agree.
I love it. And Steve, we can really see your bull and bear art there. Perfect.
Sign of the times.
Yes. We're hearing your feedback. I've also invested in a mic. We are listening to you guys. So thanks to all our viewers for all their questions. We're going to get to some of them. Why don't we just start again with a market overview? John, in Toronto, you were mentioning last time we spoke, there was signs of some heating up. I think, if I'm not mistaken, we're going to see a bit of a climb in price, average prices. What's going on in Toronto?
Yeah, I mean, it wasn't very popular last month when I suggested that, but yeah, that's the way the year's starting. I mean, I don't think anyone expected it. I didn't expect it, but the market is actually very competitive in Toronto. Inventory levels are plummeting. Like I just tweeted today that we have about 1.5 months of inventory for low-rise homes. The last time it was that low was in April of 2022, when the Bank of Canada's rate was 1%. So like, who on earth expected inventory to plummet? And again, a lot of this is right now in the GTA is just driven by, even though demand and sales are like 20-year lows, the demand is outpacing the supply of new listings. Like, just to like put some picture and sort of context to it, when we look at what has happened from January to February of this year, 2023, in that 1 month period, we had 1,300 more homes sell in February than we did in January, but only about 500 more new listings hit the market, right? And this is why inventory is trending down. This is why prices are actually trending up. I think they're at like their highest level since June, like average prices for low-rise homes. Condo prices have been a little bit more stable, but low-rise prices have picked up a little bit. And again, I mean, it's just shocking that this is happening, but I'd say the biggest factor right now is that just listings are so low and no one's selling. And the few buyers that are out there are finding it tough to find something that's available.
So what do you find shocking, John? Because you've already mentioned in your previous updates that, January, February, we normally see a bit of this, I'd call it a bottleneck, where buyers tend to jump in even cyclically every year faster than, maybe sellers are ready to list. The shocking part of this was what? That the high interest rates didn't keep these buyers away?
Yeah, I mean,
or that the sellers aren't there.
It's both. Like, I mean, I would have expected that the higher rates would kind of keep a lid on demand. Do you know what I mean? And that we would not be in this environment where sales are outpacing new listings on the one hand. And on the second hand, I would have expected at least a slightly higher volume of listings hitting the market. You know what I mean? And again, we talk about distressed sellers, and are we going to start to see that as rates go up? The reality is, before people like default on their sale, they put the home for sale to try to sell it on their own terms, to try to move on if, they can't handle the higher rates. And we're not seeing that. Like, people are adjusting, and part of it is that the banks are just not increasing people's mortgage payments. And Steve and I tweet about this, and extending amortizations, allowing people to like effectively have their mortgage payments not even cover the interest now. So the banks are working with owners, and this is one of the reasons why we're not seeing a ton of listings. And I did not expect that to happen. And again, I think that's one of the reasons why the market's just behaving the way it is.
Okay, well, let's dig more into that. But first, I want to go to Steve. Vancouver, what's the situation there, Steve? Are you seeing the same kind of pattern? Low level of sales, but prices holding or going even slightly up because the demand is really outstripping the supply?
Yeah, just to quickly touch on John's point, because I think it kind of, his last point being, you're not seeing this distressed selling, and so we know that obviously people, their mortgage balances are growing. They're basically, negative amortizing at this point, so your amortizations are extending from, original contract was a 30-year AM. Now it's turned into a 45-year AM. So and that's not resulting really in these distressed listings coming to market. So I'll just give you a quick idea. I had a conversation with the gentleman a couple of weeks ago, and so he calls me up and he says, I've got a house, an investment property. I bought it near the top of the market. I don't really want to take a loss on it. But basically he says, well, I don't need to sell it because my mortgage payment hasn't changed and the rents are pretty much covering. And I said, so you must have done a fixed rate. He goes, no, I did a, floating variable at TD Bank. But what they do is they don't increase my monthly payment because when I originally bought the house, I was 70% loan to value. And so they basically allow him to sort of all the excess interest that he should be paying, but he's not paying. They're just tacking it onto the balance. And they allow you to do that so long as you don't exceed 80% loan to value. So long story short is, in my opinion, if that wasn't the case, it probably would be a listing that would be coming to market. But the idea here is, well, let's hope that rates drop in 12, 18 months from now, and his problem pretty much goes away. Obviously, we're gonna see how that plays out, but I think that's a really important, topic on the distressed listing side. And Vancouver market pretty similar to the GTA. I mean, it's a strange market, everybody on, Twitter, YouTube commenting and looking at like one data point and sort of extrapolating their opinions on the market. It's really tough because you have to sort of sift through all the data right now to try to figure out exactly what's going on. And the reality is that new listings are so weak. Demand is still relatively soft, but the new listings are basically so weak that if you do have, let's say an entry-level house, like the chances are you're probably going into multiple offers. Prices are moving higher. Plenty of examples of that, but basically if you had a property listed for sale 3-4 months ago versus today, you're getting a higher price today. And that's simply a factor of sentiment has changed. So you can't go in and lowball sellers right now on a lot of product. They go, I got no competition, I'm not dropping my price. And so it ends up in multiple offers. We had a 26-year low in new listings in Greater Vancouver, 26-year low. So again, I didn't have that. That wasn't in my sort of crystal ball coming into the year. So it's strange. I mean, like I said, to John's point, I mean, sales, if you look at them, they're still weak. They're still well below 10-year averages. But it's also a function of there's nothing for people to buy. And so we're kind of in this weird stalemate where would-be sellers, I think there's just like there's uncertainty. John, I'm really curious your thoughts of like, why are people, because people keep asking me, why are they not listing? Where's all of the inventory gone?
Well, John, can I interject to this tweet you threw up?
Yeah.
Why are there so few homes for sale?
Yeah.
You retweeted Ryan Lundquist's great image here. Homeowners not selling. And the image below is a very proud, I think they're at a Mozart concert. My mortgage rate is 2.25%. I'm not going anywhere. That is a question. Like, I have a feeling, John, are people not stuck? Like, are we not seeing the usual people that would upsell or try to upsize, try to get the bigger house, get out of their condo into a house for their kids, not wanting to requalify at higher mortgage rates or not being able to?
Yeah, I think that's part of it. Like, I think part of the low listing volume is that, people aren't moving. You know what I mean? Like, people aren't upsizing because like they have a 2.25% mortgage rate. They don't want to go and renew and get a 5% mortgage or 5.5%. Rates are higher. It's harder to upsize than what it was 2 years ago or a year and a half ago. So I think the fact that fewer people, like, because everyone who upsizes is a potential sale as well. So we're seeing less of that happening. And I think we're just seeing like investors just buckling down. Again, I didn't bank on banks being so friendly to people with variable rate mortgages and allowing them to have this, like Steve said, negative amortization where their payment doesn't even cover their interest. I mean, I didn't predict that. And that obviously has a huge impact on the whole housing market. If that if that borrower, if all of those borrowers who now have negative amortizations, if they actually had to increase their payments to not just cover the interest, but also pay down the principal, like their payments would have gone up 30+%, you would have seen way more listings hit the market. Like not most people can't handle that. Like investors can't handle that. And that's one of the reasons I thought we'd see more listings, but the banks are being very friendly.
I gotta interject there.
What? Go.
Go for it.
Well, I
Steve.
mean, let's be honest, right? It's like, I mean, the banks are doing this. This helps the banks. I mean, the banks are lending money against your house. Okay, when you have 20% of loans, at CIBC that aren't even paying enough interest, their monthly payment isn't even covering all the interest. They can't have all these distressed sellers flooding the market and basically tanking prices and tanking the market. That's the bank's collateral. So let's call a spade a spade.
Yeah.
The banks are essentially working together here to, I think, work through this issue. And so again, it's kind of curious, because this becomes a bigger problem, a year from now, 2 years, 3 years from now, and if people come up for renewal and they're going to have these sort of balloon payments, they're going to have to figure out. Now, I think it's unrealistic to sit here and suggest that the regulators are just going to sit idle.
Mm-hmm.
So if it really becomes a massive problem, OSFI works for the bank. OSFI works for the banks. They don't really work for the people. They work for the banks. And so I'm curious, like what if anything, what they do.
Steve, let's jump in here and unpack a bit what you're saying. So you're talking about OSFI, the regulators of banks, changing things around. You had a great tweet here. Both TD and CIBC have just over 25% of their residential mortgage book with amortizations greater than 35 years. Last year, that number was basically zero. So they're changing things on the fly, and apparently OSFI is allowing it.
Well, they're allowing, I mean, I suppose, they're basically allowing people's amortizations to grow, right? So, and I'm not saying that, OSFI should come in and should do this. I'm just saying, like, I'm just trying to be practical and saying, okay, like, if I'm a regulator of financial institutions and my sole mandate essentially is financial stability, this is a pretty glaringly obvious financial stability risk. So how are the regulators going to deal with it if it becomes a larger issue in 12 to 24 months?
Well, 25% is an issue. And correct me if I'm wrong, guys, we shouldn't be seeing 35-year mortgages, right?
Correct.
Yes, but it's on origination, right? So you can't originate a loan with a 35-year AM.
Right. But they're through a back door. This is now happening.
Essentially, yeah.
So this is already happening.
And if you chat with anyone that actually works at the bank that's relatively high up, they'll tell you what they're doing, right? So they actively work with each borrower. They don't, like, the bank doesn't want their clients to foreclose. So it looks bad on the bank. It looks bad on the homeowner. It's not good for the market. And so they actively work with people to sort of get them back on track. And so they will allow people to sort of refi and extend their amortizations, behind the scenes. So it is happening. Like the reality is you can't raise rates 400 basis points in a year and expect that there's not going to be issues. I think there are issues, but we're kind of figuring it out and working through it, similar to like the mortgage deferrals at the beginning of the pandemic when, everyone's losing their jobs. Like, I suppose, what did you think the banks and the regulators were going to do? Just let everybody foreclose? So they allowed mortgage deferrals. And I think we're kind of seeing a similar thing, which is they're allowing people to basically extend and pretend. So
I love that, Steve. Thanks. Extend and pretend. Love it. John, let's put up a tweet here. Steve already alluded to 20% of CIBC mortgage holders are in a position where their monthly payment is not high enough to cover even the interest portion of their loans. I've heard you say that you can't believe you're seeing that in Canada. Can you unpack why that is astounding?
I mean, it's astounding just to think about, like, you have a mortgage on a home and your payment doesn't even cover your interest. Like you're basically, your debt is actually growing every year. Like, if you think about this and you talk about this like 2, 3, 4, 5 years ago, like no one would think that prudent Canadian banks would allow that, right? But like, to Steve's point, there are a lot of reasons, and he's 100% right. They're not doing this with everybody. If you're like if you bought with 10% down a year ago, and prices have declined, like you're not doing that today, right? You need to have a certain amount of equity and capital. And I think part of it is, as Steve said, the banks don't want to take your home. They want to protect sort of the house prices. I actually, the other big factor I think is also, I think between the banks and, the federal government and Finance Canada, they're worried about a massive shock on consumer spending. If everyone's mortgage payment goes up $1,000 or $1,500 a month because of this payment shock, that's less money they have to spend in the economy. That takes us from a mild recession to a deep recession, which leads to bigger issues. So I think there's a lot of reasons why the banks are doing that, but it's surprising that, to me, at least, they're not even requiring people to bump up their payments to cover their interest. I think that's what I find the most shocking. You know what I mean?
And different lenders, I know, like, for example, RBC requires you to put at least $2 each month towards your principal pay down, $2. But at least, like you can't negative amortize. You can't tack it onto the balance. There are certain lenders, CIBC, TD, I think BMO actually as well. I could be wrong, but they do allow you to basically tack on that deferred interest.
That's interesting.
So that brings us to a question that I think you guys have been touching on from a viewer, Road and Bridge Guy. Question: is the mortgage amortization extension by several banks just creating additional supply constraints? In a normal environment, those mortgage holders would have placed their properties on the market. Some banks have up to 20%, as we mentioned, of their residential mortgages in 35-year amortizations. I think, Steve, you said yes.
Yeah,
we would see those listings.
Yeah, anecdotally, because I get the phone calls on the other end, right? So, hey, what should I do? This is my situation. And so, a lot of the times, like I said, John, I think I've definitely heard, seen, worked with, some investors that they have been, their payments have gone up on their variables and they aren't able to raise the rents. And so they have been, they'll say, I don't want to lose $600 a month anymore, $700, $800 a month on my investment condo. Let's sell it.
Mm-hmm.
And some are selling, and then, maybe they have a portfolio of 2 or 3 condos. They might just sell 1 or 2 just to sort of, get increased liquidity. So no doubt we would have more listings, I think, if you had sort of a true price discovery.
So actually, Steve, let's stay on your point there. Another viewer question here from Victor D. What percentage of your investor clients are over leveraged to the extent that they would need to sell in the next 6 months? Now, is this a case of the clients that you mentioned having to sell, or them trying to balance, like you said, a portfolio of a couple properties?
Yeah, all of them. No, it's I don't have like
we don't like to use the word all here at Moose Riley because we're
I don't call my clients. I don't call my clients and ask them to send me their all of their cash flow statements every month. Honestly, like, I think anyone that follows my work, I think, knows that I'm a numbers guy. I'm certainly not like a pumper, and it's we educate our clients to the best of our ability and let them make their own decisions. So I'm not really like huge on the investor side, to be honest. We definitely have a decent amount of investor clients, but I would say a bigger part of my personal book of clients tends to be a lot of young families.
Mm-hmm.
Right. But even practically, John, like, I know that even amongst your clients, these are not big time investors. These are people that, probably didn't sell the condo they moved out of when they went into their bigger family home. Yeah. Are you hearing from people like that now? There was a time where holding on to those properties was fine, and it was actually a great move.
I mean, Steve's right. I mean, I don't follow up with past clients, ask them how they're doing. That's not a good conversation, but I'll say that I haven't had a lot of calls. Like, usually if people are feeling the stress, they think they might sell, you get calls. I mean, some clients who I speak with regularly have investment properties, have commented to me that they're with Scotia and their payments went up and they're managing it. You know what I mean? So I haven't heard personally a ton of distress from investors. So that's, again, I think I don't know if that's just them being able to manage the payment increases or just working with their bank and they're not seeing it yet.
Yeah, I would say that too on my side. I'm not getting, it's not a couple phone calls every day, right? It's like, it's the odd one, but it's an interesting, these are interesting anecdotal conversations where, you're like, oh, okay, like it is happening. It's certainly an issue for some. But I think for others, like, I haven't heard from a lot of our investor clients. So I assume it's all good status quo. Again, it kind of depends. When did you buy it? What did you do? Like, not every investor is on a floating rate mortgage, right? So it just depends.
Mm-hmm.
Let's turn our attention then to buyers. We have a question from Ali. Who is buying at these rates? Basically, has there been a change in buyer profile, investors, first-time home buyers between January and February this year compared to last? Is there any data release available that sheds light on this? Another question from our viewer, AG Chennai. Any insight in who are the people buying homes for 1 million stress tested at 6 and 7s? Are these first-time home buyers, upsizing families, institutions, or investors? So a real question out there, who are the buyers that are out there right now?
John, you want it?
Yeah, sure. I mean, what we're seeing is it hasn't changed. Like, they're disproportionately families, a lot of first-time buyers, some upsizers. I mean, and I think one thing to just keep in mind is that, with rates the way they are, and just with everything that has gone on, like a lot of housing purchases now are driven way more by capital than by income. And what I mean by that is, like, you can only borrow like 4.5, maybe 5 times your income in Canada. Like, it's probably closer to 4.5 now with rates the way they are, or maybe even 4. But prices in the GTA are like close to 9 or 10 times income. So that difference is coming from somewhere, right? And people are getting either, they've owned a condo for a very long time and they have a ton of capital in it, and they're just moving that to their next home. So, they have like a 50% down payment or 40% down payment, or they're getting money from family as a gift. So all of these types of things, I think, are behind the demand that we're seeing. It's not like, first time buyer with 5% down payment. Usually people have much bigger down payments.
I think that's like so spot on. It's like, you look at these prices and yeah, I get it, right? You look at the incomes, you go, well, that doesn't make a lot of sense. Like, big people are, I don't know where they're coming up, but people are coming with large down payments. Like, the biggest sort of factor of what I see, like what's the hottest segment of the market right now? In Vancouver, that's entry-level detached house. So basically anything that families can sort of find a way to get in, like their family's growing, they're not going to sit on the sidelines waiting for 2.5 years for the market to like maybe not crash. Like, they need to get on with their lives. And their family's growing, they want their kids to go to a certain school. They got to move. They're tired of waiting. And so they're making moves. And they're begrudgingly accepting obviously 5% mortgage rates, but any house in Greater Vancouver that's, listed under 1.8 million, it's going into multiple offers. That's, basically an entry-level house. Sad to say, but that's what the entry-level house basically costs. And there's a ton of demand out there, because the reality is you've got, I think a lot of these young millennial families are starting to grow. They're starting to have kids, and they need the space. And we don't build new single family houses in Greater Vancouver. We're not adding more new houses into the market. We're building more condos. We're not building more houses. And so I just think there is a perpetual demand, I think, at that entry level for detached house. And so that's what I'm seeing. I'm not really seeing any investors are very, very few and far between, which is a huge change from 24 months ago. But yeah, I mean, that's what I can say here.
So is the sentiment behind these buyers that things are not that great, but they will eventually be okay in the long run somehow? And that's going to bring me to this discussion of bear traps.
I mean, I think to some extent, like, I think a lot of the people moving just need a home. I think that's what's missing in this when we think about who are the buyers. Like, they just started a family, they just had a kid, or something is like pushing people to move. You know what I mean? And I think that's a lot of the purchasers today. And I do agree. I think a lot of the sentiment is, okay, I'm buying at whatever X% now, but rates are only going down from here. You know what I mean? Like, and obviously people realize it's not immediate and it might take 2 to 3 years. But I think people are thinking that, they're buying at these higher rates, they'll lock in for 2 years, and 2 to 3 years from now, they'll have a lower mortgage payment because rates will drop a little bit. So if they can just muscle through this short period.
The big thing I've noticed, John, in the market is just like the sentiment change. The sentiment like 4, 5, 6, 7 months ago was just horrendous, right?
Yeah.
Like, when Tiff Macklin was raising rates 100 basis points at a time, and everyone's like, oh my God, how high are they going to go? How bad is it going to get? Like, people don't want to make decisions. They don't want to make a $2 million decision when someone's raising rates 100 basis points at a time, shocking the system.
Mm-hmm.
Now that we have at least a little bit of clarity, people at least feel more certain. They feel more certain that, okay, this is probably more or less how high rates are going to go, maybe a little bit higher, maybe, but they have some certainty. And so they're re-entering and transacting in the market. And so, I mean, I always say, like, you want to be negotiating when sentiment is the worst, right? Like, you can really go in and lowball a seller after 100 basis point rate hike and say, hey, listen, like, it's bad out there, it's ugly, and you can get some good deals. And I still think the best deals so far have been negotiated, end of summer, early fall.
Mm-hmm. Yeah, but a lot of people hit pause then, hoping prices would fall further, right? And I think, and we talked about this, I think in the last episode, I think that's one thing that's fueling the demands today. It's all those people who hit pause in the fall, expecting prices to tank, and they've been flat since July, and they're like throwing in the towel and basically saying, all right, I need a home now. Like, I'm sick of sitting on the sidelines, right? That's why we have this slight bump in sales, I think.
And this is coming back down to the bear trap.
Yeah. So let's put it up there. So this is a chart that makes the rounds. I'm going to describe it a bit for our listeners. You've got basically, let's focus on how the public reacts. There's a mania phase, enthusiasm, greed, delusion, new paradigm, denial. And that denial then is, okay, the new paradigm was probably, we can sustain these prices, it'll always stay here. Then that falls. And that's what we're seeing right now. Now, I said a bear trap. It's actually a bull trap. What am I saying? Sorry, guys. But then all of a sudden, in the middle, people start to, like John used the word, throw in the towel, or maybe this is just how it is. So there's like this return to normal feeling. Now, is that setting us up for a trap?
You want me to take it, John?
Or you can start. You can start. I'll hear what you say, and then I'll jump in.
I think it's certainly possible, right? I mean, to rule out, I think right now there's still a lot of uncertainty. There is. I think it's going to be a very volatile year. And so, yeah, the short answer is I don't know, and I think that should be the answer from most people. But I think part of this a little bit, John, it kind of concerns me around like what. So in Vancouver, I think we're a little bit ahead of you, but in 2016, we kind of had that blow off top, and then the market started to kind of slowly roll over, and then the government brought in the foreign buyer tax, and then the market just completely tanked. It froze for about 6 months, and then it actually came back to life in the spring of 2017, and people said, "Oh, see," and so we had a pretty good spring of 17, and then the market after that rolled back over, and 2018 was quite a soft year. And so I think that's certainly a possibility this time around, right? I mean, I think certainly when you look at in between the weeds, like all the mortgage deferrals that we talked about, or not mortgage deferrals, but these amortizations that are growing. I think, the reality is you've got very indebted households, and rates are up 400 basis points. I think that's going to start to bite on consumer spending and the economy. And so I still think there's those risks out there that this could very well see, a soft housing market next year. Hard to say.
So, and the issue is, maybe it's more like a frustrated bull trap, because I'm not getting the sense that the buyers are exuberant, but they're almost like, oh, well, this is how it is. And, if we get back in now, is the concern that some of these buyers could be underestimating the risks when we talk about a bull trap?
I mean, when I talk to them, I think most people buying today, I mean, just my perspective, most, I think, understand the risks and appreciate that prices might dip further, right?
Yeah.
I don't think most are expecting like a 40% crash, but I do think most think that it's possible in the next year, year and a half, that prices are down a little bit. And I think people just don't care because they're buying for 5 to 10 years and they need a place to live, right?
So it's a new being. It's the new bearable.
Yeah, I mean, and Steve, I mean, yeah. I mean, Steve's 100% right. I mean, we don't know the correct answers. We don't know the path. I mean, we'd be silly to say that there are not still risks and uncertainty. I mean, rates could go higher than we think. I mean, I know everyone's talking about like just another quarter point in June, but I mean, they could go higher if the dollar starts tanking. And quite frankly, like a booming housing market almost like gives the freaking Bank of Canada more ammo to just say, yeah, okay, we'll hike a little bit more. Like, heck, you know, people are still buying houses like crazy.
I think that's the most important like message that, you know, people should take away. Cause I hear it in the industry, right? Like naturally it's an industry that like likes to hype things up and you know, one of the hype things I'm seeing a lot, and you see it on TikTok and Instagram and all this stuff. Oh, you know, market's back, multiple offers. It's like, well, careful what you wish for, because if it truly is a sustained rally, like why would the Bank of Canada even contemplate cutting rates? So it just means higher for longer, which I think creates more issues. Higher for longer, I think creates more issues. So yeah, I like I said, it's just a strange market right now.
Yeah. So let's do a quick interest rate corner on that note. You touch on it. Bank of Canada meets tomorrow. What are your predictions, not only for tomorrow? I think a lot of experts are suggesting there may just be a pause. The pause continues, no movement on the bank's policy rate. And what do you think might happen over the year? I think you've already touched on, you know, if we see more of this growth of this boom in prices in housing and other sectors, you expect that the bank would actually have to come in and start cutting rates. So why don't you both explain why you're thinking about that and why the disparity between the Canadian and US dollars is playing into that as well?
John? Okay, I mean, I'll sure. I mean, so, you know, I think the consensus is potentially another hike in June. You know, but again, one of the concerns, of course, is that, you know, the Federal Reserve in the US, you know, has way more hikes ahead than Canada does. And, you know, one of the arguments is, well, what impact is it going to have on the dollar? And will the Bank of Canada have to, they're not going to match like point for point or hike for hike, but will they have to be a little bit more aggressive to protect the dollar? And, you know, I think we have to be open that that's 100% a possibility. I mean, whether that's an extra 25 or 50 basis points. And like I said, a booming housing market gives them more ammo to do that. You know, an economy, if things are relatively stable, gives them more ammo to do that. Strong jobs like that we've been seeing recently, like strong job growth, gives them more ammo to do that. So it's very possible like that we might see that you know, in the second or later half of this year. And like Steve said, I mean, this just kind of doubles down on this higher for longer. And again, I've always been more concerned, quite frankly, about like next year more than this year, because like the longer rates stay high is like, you know, then things just start breaking. Like you can only do this negative amortization for so long, you know what I mean? And you know, eventually people are going to have to renew their mortgages, you know, and then they're going to feel the payment. You can't renew with a negative amortization. They have to renew at a proper, you know, mortgage payment. Even if it's at a 35-year AM, they're going to feel that increase.
Yeah, I think my view is, you know, a continued pause, you know, tomorrow or whenever, you know, this is being released here, continued pause. I mean, you had fourth quarter GDP coming at 0 flat. You know, the BOC's estimate was for 1.3% growth. So that was a huge miss. Something they'll obviously be watching. But yeah, the reality is, you know, to your point, I mean, I don't see how you can keep pace with the Fed. I mean, the reality is you'll probably have a weaker Canadian dollar as a result. But I think Canada has about 30% variable rate mortgages. I think in the US it's about 9%. But not only that, like, let's be honest, pretty much all Canadian mortgages are essentially not fixed mortgages. I mean, as long as you can fix them for 5 years. So like the interest rate sensitivity is so much higher in Canada. I mean, you can go to the US, people were taking out 30-year fixed mortgages at like 3%.
Yeah. Well, that's
12
the
months.
norm in the US
Yeah.
is to have 30-year mortgages. Yeah.
30 years, right? So
Yeah.
it's like just like there's no like there's very little like the monetary policy channel to flow through to households in the US. It's much different than in Canada. So yeah, I think people that think we're going to go, an eye for an eye with the Fed, I don't see that.
So let's actually talk a little bit more about that. I'm calling this another from the pile of money stuff that's not working like it used to. John, you tweeted about Paul Krugman making an observation. This was actually interesting from the American perspective. So I'm going to put it up here. The most puzzling chart in economics right now, much speculation about why US Fed hikes haven't done much to slow the economy, but too much focus is on business and consumers. Housing is where monetary policy usually has the most traction. So his point being, if you were looking at, and he has a chart here showing that while the monetary policy change has dropped housing starts to almost, a very sharp drop off. I'm not sure it's landing there. Probably around I'm seeing maybe dipping below or at the 1,000 units level. Huge drop off, you can see. For some reason, he's noting that the employment level in residential building construction is remaining extremely high and is growing. That's the blue line there for viewers. So this is very strange. If you were looking at, Paul Krugman says, if you're looking at housing starts, you'd think there was a significant slowdown in process, but employment hasn't declined at all. I honestly don't know quite what's happening, but surely this is a large part of the mystery. So John, are you into UFOs and other mysteries? What is this?
I can't speak for the US market, but because I don't look at this, but if we look at Toronto and Canada, I think we'd see very similar trends. Like we're going to see construction start slow down, but we're not going to see a massive decline in labor, quite frankly, because it takes time to do that. A lot of it has to do with the fact that, at least in the GTA, a lot of our construction is high-rise condos, right? So the key thing is to look at not just what the starts are, but how many units we have under construction at any given point in time. And that is going to take longer to dip down, right? So, as long as we're building, and I think we have like a record number of houses under construction right now, as long as we stay close to that level, we're not going to see a massive drop in construction labor. I don't think so. I think we'd have to see this go on for years before we see that.
To make sure I understand, John, you're saying because that record number of completions we've seen, like condo completions, we have a record. I believe we're at a record number of not condos, houses under construction. So low rise and condos. And it's a record number because we're building more and more condos, and those take longer to build. So they sit in our data of under construction for a lot longer. Right. But then that means because that mix of properties has changed, the idea that you can try and cool down, wages or whatever, that part of the piece you're trying to do, there's a bit of a lag maybe because of the type of properties that are under construction.
Yeah, exactly. So, I think it'll take some time before we see that kind of flow through into the economy. And that's kind of go back to why we think higher for longer is bad. Like we'll muscle through a decline in construction starts this year, but if housing starts plummet again in 2024, like the longer this goes on, the more likely you start feeling the impact on the economy. So, whereas the US can be very different because I think they have far more low-rise construction. So it could be more puzzling in the case of Krugman's original tweet.
That's it's funny that you brought that up, because I was literally reading a thread this morning from Francis Donald retweeted it, but it was from Eric Basmagian. I don't know. He's a good follow on Twitter. He's got something like 100,000 followers, but he puts out a lot of good economic research where he actually basically just explains sort of Krugman's question, which is essentially that building permits typically peak out and then construction employment follows suit. And it's always construction employment on the residential side. which is extremely volatile and sensitive to the change in permits. And so that will actually be, you'll probably see the steepest drop off in terms of job losses actually in the residential construction sector. So he basically argues that just because it hasn't happened yet doesn't mean it won't. Because if you look at in the US, permits are in fact rolling over. And so it's probably just a matter of, months, at least in his opinion, until you start seeing employment in the residential construction side. I think that's the same in Canada, right? I mean, we all know like housing starts are rolling over more so to John's point, right? Like where you're seeing that big drop off is in single family houses. We don't build a ton of single family houses because, we build mostly condos, and once the permit's approved and your concrete's poured, you're going to finish off that job. So you'll see the sort of slowdown, I think, years ahead.
Yeah, that's helpful. All right. How are we going to finish off today? I thought I would maybe poke you guys back a little bit. So There's been a lot. I'm a patriotic Canadian. There's been a lot of blaming Canadian officials and, everything, and rightly so, with how our housing and our economy is being managed. But looking at a recent article in The Guardian, I noticed that global surveys are showing that housing prices are coming down after years of low interest rate fueled booms, not only in Canada, but this article points out there's Canada, there's the usual suspects, Australia and New Zealand, of course, but interestingly, also Sweden and Germany, other markets that have had the reputation of being more stable, have also seen, huge drops after low interest rate fueled booms. And then similarly, Steve, your colleagues on the Loonie Hour podcast are pointing out that inflation, when it comes to the inflation battle, everybody's kind of like all hands on decks trying to get that fire out. And now we hear that Spain and France is seeing record-breaking upticks in inflation. So is Canada, just being pulled along by these factors, or is there something that makes you point to the fact that, Canadian policymakers could have done, should have done, or seen something to do things differently here? Or are they just kind of, being pulled along by the whims of these international trends?
I think, Canada's certainly not, Bank of Canada is certainly not a monetary policy setter. I think they basically import their monetary policy predominantly from the Fed and larger central banks. So we're kind of like order takers. But the reality is domestically, what can policymakers do? Well, yes, we should have higher rates. That's been the biggest driver of housing prices over the last decade is interest rates. But I think, what you can do, I guess, more domestically is you can control immigration pretty easily with a lever. So, dialing that up and dialing it down when necessary is a pretty obvious one. I think that zoning is another big one that's pretty easy to change with a lever, but nobody seems to want to have the political appetite to do that. So it's really hard to get things built. There's a lot of red tape, a lot of bureaucracy. So I don't know. There's just so many things. It's such a complicated piece here, but I think there's a lot of levers that people could have pulled. We clearly overstimulated. We clearly sent out way too many checks in the mail during the pandemic. I remember testifying in the House of Commons there, whatever it was, just before they passed their last round of stimulus, saying, hey, you guys should keep an eye on the housing market because this is flowing over into that, and obviously nobody cared anyways. But it's just so many policy errors are on so many different levels, really.
Oh man, do you have a C-SPAN clip of that? I'll throw it up here.
Yeah, I had it on. I think it's still on YouTube. So I'll see if I can send it to you.
Throw it over to me. We're gonna put that in there. We care. That's a highlight.
Now we have Mr. Steve Saretsky.
I think some of the ramifications of the spending that's coming through, there's always knock-on effects, and I just think that we have to be cognizant of those knock-on effects, which I think that certainly we're seeing that showing up in the housing sector.
John?
I agree with Steve on the monetary policy front. The Bank of Canada is just kind of following the Fed for the most part. I think when we look at the bank, I think my criticism for the longest time, and I think most people are starting to come around to this as well. And I think the chief economist at TD wrote a note about this, that the biggest mistake probably was, what they call his forward guidance, which is basically like, the Bank of Canada has different levers, which is, the policy rate, they have quantitative easing, which they did, but forward guidance was just like their statements about the future. Remember that classic Tiff Macklem where he said rates will stay low for a very long time, go out and take on debt and buy a home and take on a mortgage. Well, that was a mistake, right? To be that aggressive, because it partly contributed to this frenzy that we saw. But with respect to house prices, listen, everyone in the world complains about house prices. Canadians have been complaining about house prices since I bought my first home like 20 years ago. So the complaints about high home prices is always a relative argument, right? Based on where home prices were a year or two before this current year. But the fact is, when you look at Canada, we're 100% like off the charts when you compare us against most other countries around the world. If you look at, there's this classic chart of like comparing Canada's house prices and incomes to the US. And it's like, Canada's just exploded relative to the US. And yeah, these are not all perfect metrics, of course, do you know what I mean? But definitely Canada's significantly more expensive than most other G7 countries. And I think we are actually the highest, like if you look at price to income, price to rent across the G7. So Canada has its own challenges. And like Steve said, they have tools to do it. The funny thing is, when I posted that tweet about, kind of Krugman's kind of confusion, is like, the funny thing is like monetary policy is trying to cool the supply of housing, just as the feds are ramping up the demand from increasing immigration targets. So it's like, what do you think is going to happen? It's very predictable, the pressures that this is going to put on the market. And it is what it is. I think it's going to just.
The housing charts are kind of interesting though, right? So I always have to put it into like context, because I chat with a lot of American friends and investors and stuff over there. And, they always flag the Canadian housing market, which they have every right to. It's from an outsider's perspective, it's bonkers. Even from, locally here, it's pretty crazy. But like, you have to remember that it's like everybody basically funnels into like the GTA, all the immigration, and like how much of the GTA makes up like the national house price index. It's like it takes up the bulk of the index. And so I don't know, always look and say, well, housing's pretty affordable in Alberta, Saskatchewan, and Manitoba. But the reality is that most people don't want to move and live there. So, and there's just a lot. Outside of Alberta, obviously, there's not a lot of economic prosperity. And it's funny, because I was chatting with immigration consultant last week, and he's like, yeah, like the reality is, he's like, I help bring these people into the country and get them work and all that. And he's like, the reality is like they start here and they end up in the GTA and they end up in Vancouver, and that's where everybody goes. And there's just, so you inflate the value, home values in these two large cities.
That's a great point, Steve. Even that global survey from The Guardian showed that in the US, while they didn't have the overall drops that we were seeing in Australia, Sweden, and Germany, San Francisco had, the Bay Area. So It's like taking some of their rocket ships that go up and down on their roller coasters and concentrating it in Canada into the two biggest cities here. And that actually is a nice endpoint, I think, to leave off on. In response to your call for questions, John, someone said, how come people can't figure out that the hovels we're buying here for $1 million in Toronto and Vancouver are overpriced? They're not great. Look at Detroit, look at whatever. Well, I don't mean to be rude, but is the choice, do I want to live in Detroit or Toronto? I don't think most Canadians have the ability to just pick up and move wherever they think price of values are correct for homes.
That's the one nice thing, honestly, about the US is the optionality, right? It's like, think of many like large, amazing cities you've got there. If you get priced out of New York, you go to Arizona or Nashville or
not
Boston.
even, and think of the tri-state itself, and how like the tri-state area allows all these commuter satellite, towns. So, I do think we sometimes, we have that effect here with the GTA and the Hamilton and things like that. But just think of that, like you were saying, Steve, around Atlanta, that happens, around Houston. Like, it's on another level.
You get priced out of the GTA and you move to, you know, Moncton, New Brunswick, with a population of 100,000 people.
Yeah,
It's like,
exactly.
you
You're not
know,
moving to
100,000
like,
people is like a small, like tiny little town in rural
yeah,
United States.
Yeah.
yeah, you're not going up to like upstate New York, for example, and all those cities there, you know, Poughkeepsie, all of them are a decent size. So yeah, I think there's sometimes, I know John and I have kind of rolled our eyes sometimes about the comparisons, but there you go. I can understand people like when you do the scan and you're like, oh my God, Ryan Gosling just bought a house in LA. It's like the same as my neighbor down the street. Shocking.
You get that
I'm not
nice
gonna
house
lie.
in Saskatoon,
There you go.
$500,000.
Yeah, so there is a bit of a product comparison fail. I can understand that frustration. All right, guys. Well, any other thoughts as we close out? I thought it was very interesting talking points. We'll see where we go next, I guess, next month.
I think we're in the, you know, we're entering the spring market now here in March. So March, April will be very interesting months to analyze. Typically your busiest, most active months in the housing sector. So it'll be interesting to sort of see how the data comes through.
Yeah, for sure. And I think we'll have maybe some other guests along too, to see like, are these distressed sellers showing up in the data? You know, because it is really odd. We're in a real like anecdotal kind of situation. So let's see what comes next. Thanks, guys. It's always fun making sense of things with you. And yes, to our viewers and listeners, keep your great questions coming. And we'll talk to you next month.